Good afternoon. We'd like to welcome everybody onto this webinar this afternoon. It's great to be able to host you all. And we've had a really good response to this webinar. We've got a really good list of attendees that are on here. So it's really brilliant. We're really pleased with the level of response we've had to this webinar. So we're looking forward to a really good session. And 2020 has really been a year like none other. And we've all faced massive pressure in our businesses in many different ways. And I think we're all looking forward to 2021. So this webinar is really all about doing just that. It's really about doing everything we possibly can to help businesses prepare and really gear up for a great 2021. You know, we know times are uncertain and we still don't know what 2021 is really going to bring. But I think it's really important that we're all heading in to next year prepared in the best way possible. And I think it's really important that we're thinking about that now. So my name's Carl Taylor. I'm a consultant here at Oldfield Advisory, and I'm joined this afternoon by Joe Brewer, who's consulting partner here at Oldfield. Hello, Joe.
Hello and welcome. Very warm welcome to everyone joining the webinar. Thank you for attending.
We've also, I just want to sort of give you a bit of background, very brief background as to who we are as a firm. We've got some clients on the webinar this afternoon. We've also got some non-clients that haven't met us before. So I'll just explain who we are. We're accountants and tax consultants based in Coventry, and we help our clients with the reporting and the strategies they need to maximize profitability and maximize cash generation in their businesses. We also help clients with smart tax saving strategies to help them reduce their tax liabilities and keep more of what they earn. And I think both of those elements have been really important in helping clients keep control of their financial position and minimize outgoings in this challenging period. We've also got two guest speakers on board with us this afternoon. And we've got Adam Chester, who's an economist with over 25 years experience, including holding senior positions at major banks such as Lloyds, Bank of Scotland. Good afternoon, Adam.
Hi, Carl. Hi, everybody.
We've also got James Campbell with us, who is a risk management consultant from Cambridge Global Payments. That's a global company that helps businesses with currency risk management and payment solutions. So hello, James.
Good afternoon, Carl. Thanks for having me on, and good afternoon, everyone on the webinar.
Great to have you on board. So there's really four key points that we're going to be talking about in this session today. Firstly, Adam is going to give us an overview of the current economic outlook. Then James is going to touch on some further key points on foreign exchange, key things businesses should be thinking about over the next few months. Joe is going to be touching on some of the key tax opportunities that there are on the horizon over the next 6 to 12 months. And I'm going to touch on three key tips to help maximize profitability and cash flow as we move into 2021. Then there's going to be a chance to ask questions and get some answers at the end. So if you've got any questions as we go through, please do feel free to put those questions in the Q&A box as we go through the presentation, and we'll gather those up at the end and do our best to answer those. And feel free to use the chat box to contact us if you've got any technical problems. Put those in the chat box. But remember, if you've got a question that you want answering at the end, put that in the Q&A box. We will be sending out a link to a copy of the slides after this session. So look out for an email following this webinar with a link to that, and you'll be able to access the slides then. So we're going to keep things moving. I realize everyone's busy and we've got a lot to cover. So I'm going to hand over to Adam, who is going to kick us off on the UK economic outlook. Thank you, Adam.
Thank you very much, Carl, and thank you to Oldfield for giving me the opportunity to speak this afternoon. Something of a poison chalice for economists at the moment. Just when we thought conditions couldn't be any more challenging, Boris Johnson and the European Commission go and put a further spoke in the wheel. Well, obviously, the outcome of last night's negotiations looking like we're not necessarily going to get a deal after all, and a lot of economic forecasts, I think, for 2021 onwards are predicated on that happening. So clearly a lot up in the air at the moment. We're going to have to see the shape of the discussions over the next few days. They've put in a new deadline of Sunday. In reality, I guess the absolute final deadline is the 31st of December. But clearly all this does is add to the level of uncertainty, which was already extremely high levels going into the Brexit negotiations, and I'll be talking a little bit about that. So what else can you expect from me today? Well, I'll give you a little bit about the current state of play, where we are in terms of the UK economy at the moment. I'll talk about a little bit about all the uncertainty that we're facing and the risks and the range of forecasts that's out there. Looking a bit more detail about the implications of COVID. Clearly very good news that we've had the vaccine starting to roll out, and that's a potential game changer for the UK and indeed the global economy over coming years. But also we have Brexit overlaid on top of that, and I'll talk a little bit about Brexit and what the structural challenges that Brexit poses and what that might mean for businesses planning their business plans over the next couple of years. And then I'm going to talk about the fiscal borrowing. Clearly, we've seen a massive increase in government borrowing over the last 9 months or so to unprecedented levels. A lot of talk about the need for fiscal austerity. What shape might that fiscal austerity take? When might it kick in? And then I'm going to wrap up with some comments on what I think the pound might do. Clearly, yesterday's failure to reach an agreement has pushed sterling down this morning. The pound is trading back below 1 against sterling euro, sorry, 1.1 against sterling euro. Talk that it might move down to parity if indeed the Brexit negotiations do conclude in chaos at the end of this year. So to kick off, overview slide just shows where we are in terms of the UK economy, in terms of the headline numbers. UK real GDP growth is shown on the chart on the left-hand side. I think this chart doesn't really need a lot of introduction. It shows GDP growth year on year, makes the point the growth this year is expected to contract by 11%. So not growth, the actual size of the UK economy is expected to contract by 11% this year. That's unprecedented. It's the biggest economic contraction the UK has faced since 1709, when apparently we had a very, very harsh frost, the coldest winter for 500 years. So it puts it in some sort of perspective. And also, I think if you look at the other dip that we got in 2008, 2009, it almost seems like a blip. And of course, that was the financial crisis. So it does highlight the extent to which, of course, activity and spending has absolutely plummeted over the last 9 months. The corollary to that has been, of course, a massive increase in public sector borrowing. The public sector net debt figures, if you like, the national debt, now stands at £2.7 trillion. That's around just over 100% of the size of the economy each year. So if you look at it in terms of, the average person going out to borrow, it's taking, if you like, 105% mortgage. Effectively, what you've done is taken out a significant increase in debt over and above your annual income. And I think that clearly needs to get repaid. Big questions when and how that will get repaid, if indeed it'll get repaid at all, because of course over the next couple of years I suspect the government will be looking, if anything, to promote growth than necessarily undertake significant fiscal austerity, but I'll be talking about that in some detail in a moment. So those are the headline figures. If you look at the next chart, it shows the public borrowing numbers in more detail, just to put it in some sort of perspective. Total borrowing this year is projected to hit £385 billion. That's equivalent to about 19–20% of the size of the UK economy. We've seen an upward revision this year of about £300 billion, largely on the back of coronavirus measures. You can see the shaded area on the far left. £280 billion of support measures have been announced over the last 9 months. Part of that, of course, has been the cost of the furlough scheme, also other support measures for the health service and also business grants, etc. Looking at the projection going forward, of course, it is expected to fall off next year, not surprisingly, although there will be about £50 billion worth of coronavirus measures still coming through next year. But public borrowing expected to drop from about 380 billion down to about 150 billion and then slipping down to just under 100 billion thereafter. Now, what should we take away from this? Well, obviously, we've seen an unprecedented amount of borrowing this year. That is largely temporary. Obviously, coronavirus, given the rollout of the vaccine, hopefully means that actually borrowing can get on a more even keel. But the key point I'd like to make in this chart is the out years, not so much the front years. If you look at the out years, we've still got a budget deficit each year, just shy of £100 billion. Half of that is related to structural changes in the UK. Sorry, half of that is due to tax changes and weakness of growth in the UK economy, falling tax revenues, higher spending on unemployment benefits. And half of it is due to structural changes in the UK economy, effectively things we won't get back. And it's that structural change in the UK economy, about 40–50 billion pounds worth or so, which effectively the government at some point has to address. If we don't actually tighten policy by 50 billion pounds or so, then what we're really saying is that deficit will continue ad infinitum. And just to put that in perspective, total income tax take in the UK economy at the moment is about 190 billion pounds. So you can make your own conclusions or draw your own conclusions on the extent to which sort of fiscal policy needs to be tightened. There is also a question, of course, of the timing in all of this. The question of whether or not we need to get deficit down rapidly is somewhat mitigated, of course, by the fact that interest rates are at very low levels in the United Kingdom, and debt service costs as a proportion of total revenues are less than 2%. So there is a case and an argument, and a strong argument in some quarters, that actually we shouldn't worry too much about the deficit for now because interest rates are very low, the government can afford to finance it. That's all well and good for now, but of course, if or when inflation does start to pick up, interest rates pick up, then I think it will be a much more challenging environment to fund that deficit. And I think that the government will be mindful of that. So my take on this is I don't think we're going to get any fiscal austerity over the next 12 months. I think the government will let the economy try and establish some sort of momentum. But going into 22, 23, I suspect we will see in the region of 30–40 billion pounds worth of austerity. And I think most of that will fall in tax increases rather than spending. There really is very little more they can do to reduce spending in the current environment. Looking at the next chart, you can see how businesses are responding to the current economic climate. The chart on the left-hand side shows the Federation of Small Business Index. Effectively, it shows what businesses think about prospects for business conditions over the next 3 months. Not surprisingly, it's largely echoed the downturn in the UK economy. The latest drop relates to expectations at the end of Q3. So it relates to what's likely to happen in the fourth quarter. And of course, we went back into lockdown then, so sentiment has deteriorated. I think the overall message from this is clearly business sentiment still remains very depressed. It's the 8th consecutive negative reading we've had in business sentiment. But that said, I think there are grounds for optimism that actually business sentiment will start to recover. These numbers were taken prior to the rollout or news of the COVID vaccine. So it'll be interesting to see to what extent business sentiment picks up in December, notwithstanding, of course, the Brexit news as well. The chart on the right-hand side shows what SMEs believe is inhibiting their growth plans over the coming 12 months. And of course, not surprisingly, the single biggest factor cited by business is the state of the domestic economy. About 75–80% of businesses citing that as a key factor inhibiting their growth plans. And within that, consumer demand. Inflation, not a concern. Taxes for now, not really a concern. So clearly it's the state of the economy that's most important. It's the state of the economy and the understanding of that that I think is right at the top of businesses' minds. So with that in mind, if we go to the next slide, you can see the range of forecasts out there for the UK economy over the next 3 years. This shows GDP growth. The dots in the middle, the red dots, show the central expectation for GDP growth. So this year, the expectation is, with pretty much 3/4 of data in, that the economy will contract by 11%, as I said. Next year, the expectation or central expectation amongst economists is that growth will rebound by about 5%. And then it'll gradually move back to what economists call the long-term trend rate, which, if you like, is the long-term speed limit for the UK economy. And that's still put at about 1.5% to 2%. Looking at the blue bar, you can see the range of forecasts is very wide, particularly next year and the year after. The range of forecasts for growth effectively for 2021 is anywhere from 0.7% on the low side and 8.2% on the upside. Again, these forecasts were taken prior to yesterday's announcement, so I imagine the potential Brexit news could have some implications for that. But nevertheless, I think it still speaks to the massive uncertainty that economists are facing in terms of coming up with their forecast for next year. And I think it's worth bearing that in mind. At the moment, of course, it goes without saying, point forecasts are okay, but given the range of volatility and the range of uncertainty that's out there, clearly, as we've seen this year, things can come along and derail plans very quickly. So so you can see, as you say, that the range of forecasts is there. Where's that growth going to come from? If you look at the next chart, this shows the breakdown of expenditure growth. And 2020 shows, not surprisingly, that there was a very sharp hit to consumer spending. Consumer spending in the second quarter posted its sharpest fall on record. This shows contributions to growth, so percentage point contributions. So by far the biggest share of the fall in GDP growth this year fell with the consumer sector. And of course, people were in lockdown, they couldn't spend much on leisure and activities, accommodation, tourism, etc. But also business investment was down, and government spending, which might seem somewhat perverse, government spending was down in 2020. And people can think, what's, given all the government stimulus, it was down. That's really a byproduct of the way they actually come up with the national accounts numbers. The way they actually come up with them is in real terms. And the government argue that, yes, government spending went up very sharply this year, but actually the volume of government services delivered fell because, of course, schools were shut, the health service wasn't delivering the same number of medical procedures because of the COVID crisis, and public services generally impacted. So that's why the dark blue line there is negative for government spending, business investment not so surprising, and net trade, net external trade, unusually that actually contributed to growth this year. Which is positive, I guess, going into the Brexit negotiations or going into the Brexit end of the Brexit transition period. But that's largely a reflection of the weakness of consumer spending, of course, because if we don't spend much, we don't import much. And if we don't import much, then our trade position improves. All of that turns around next year, as you can see. Consumer spending is expected to rebound. Households, by virtue of the fact they've been locked up for a long time, have accumulated savings. The saving ratio, the portion of household income saved this year, is expected to be close to 19–20%. So there is a buffer of savings that consumers can bring to bear to support spending. Notwithstanding the fact that the labour market inevitably is going to weaken when the furlough scheme ends. Unemployment will rise, hopefully not by too much if demand conditions bounce back. But it's also worth pointing out that the furlough scheme has protected the labour market significantly. The adjustment in the labour market this year has occurred largely through a drop in hours worked rather than a drop in employment. And I expect hours worked will recover next year, and that will support income growth to support consumer spending. Very quickly, government spending recovers next year, of course, because we're not going to have the same depressing factors, hopefully, as impacted this year. But the trade deficit will move negative. And that will move negative partly because consumer spending picks up, import growth picks up. The risk there clearly is it could be far more negative than that, depending on obviously what the outcome of the final outcome of the Brexit discussions is. We could end up having significant problems exporting our goods and services next year, and the import tariffs that are being imposed, in particular on the non-import tariffs, could be quite difficult to cope with. Going forward to the next slide, please. So what are the impacts of COVID? So I've talked a little bit about the sort of central expectation for growth. Growth next year, I think, is going to be somewhat higher. But clearly there's a lot of uncertainty. There's a lot of ranges in terms of the potential outcomes for next year. Now, the government, under the Office of Budget Responsibility, have done some work looking at various scenarios for COVID. And the COVID scenarios they've come up with is one essential projection, which is pretty much where we are now. A vaccine gets rolled out, it proves an effective vaccine over the course of 2021, starts to get rolled out in bigger numbers from the spring. Economic conditions largely normalise. And if that happens, then effectively the OBR, the government think that effectively the UK economy will be on that central blue line, which is pretty much the line I've been talking about in the previous slides. There's clearly a better scenario than that. The better scenario is actually it's an accelerated COVID vaccine rollout. The test and trace program proves to be a lot more effective, and actually that gets rolled out very quickly as well. Businesses and households recover very rapidly over the course of the first quarter. And if that happens, then effectively you've got that dotted red line at the top. And that clearly is a much better outcome. Basically, that points to growth next year closer to sort of 10 to 11%, so a much stronger recovery. And then the downside scenario, which effectively is, far worse, not absolute Armageddon by any means. The vaccine still gets rolled out, but it doesn't prove to be quite as effective in terms of take-up. There's periodic bouts of infection again, and activity continues to remain relatively depressed. Now, what does this mean? Well, under the central projection, the OBI and the government think there's a long-term scarring to the UK economy of 3%. Now, this long-term scarring is largely a result of the fact that there might be some lost business investment, which will never be recovered. There's a loss of skills from companies that inevitably will close, who will make people unemployed, and they'll be difficult to re-employ given the skills that they've got. And there's also a loss of human capital and business capital. So effectively, the loss of investment means that productivity growth will be weaker over the medium term. Now, under the upside scenario, that long-term scarring is much sharper. Sorry, under the downside scenario, that long-term scarring is much sharper. That's closer to sort of 5% of GDP, 6% of GDP. Under the upside scenario, there is no long-term scarring. There's no long-term structural damage perceived to be done to the UK economy. So clearly, I mean, where we go with this COVID scenario and where we go with the vaccine will have long-term implications for how lasting and enduring the damage or otherwise to the UK economy is. Next slide, please. Of course, all that hasn't said anything about Brexit. Brexit, of course, poses another massive challenge. Some estimates put the long-term impact of Brexit as a more costly problem than COVID. I don't quite necessarily subscribe to that. Certainly over short term, that isn't the case. If you look at the chart on the left-hand side, you can see how well prepared are businesses for Brexit at the moment. About 30% of businesses say they are either poorly prepared or somewhat poorly prepared. And I think, I mean, 70% have made some significant preparations, but it does mean that SMEs, mid-sized companies and large companies clearly are exposed to the potential chaos that could unfold if the necessary measures aren't put in place by the end of this year to ensure smooth trade. The chart on the right-hand side shows which sectors have responded most positively and most negatively to being prepared. This chart pops not that surprising. The ones that are least, or the sector that's least prepared for Brexit is hospitality and leisure and retail. Of course, those two sectors are relatively less exposed to international trade than some of the sectors on the right-hand side of the chart, particularly manufacturing, for example. So manufacturing clearly has made a little bit more progress, but nevertheless, what it seems to suggest is there's a lot of uncertainty and a lack of preparedness for the transition to a new arrangement on the 1st of January, which of course just underlines the uncertainties that the economy is facing as we go into next year. Next chart, please. What is the impact of the Brexit negotiations on growth? Well, this is the free trade agreement versus WTO. You can see here the potential change in forecast. The forecast I did previously for COVID scenarios assumed that the UK economy undergoes a free trade agreement with Europe. If we don't get a free trade agreement and we default to World Trade Organization rules, then those forecasts change. And if you look at the far left chart there, this looks at the added impact that a movement to World Trade Organization rules, effectively increased non-trade barriers, increased tariffs, would have on GDP growth. Under the central COVID scenario, i.e. the one we've got at the moment, a movement to WTO would take about another 2% off GDP over the longer term. So the net impact of a central COVID scenario with WTO is about a 5% scarring for the UK economy. Downside, that scarring rises to 8%. The impact on the unemployment rates under the central COVID scenario, the middle chart, movement to WTO adds about 1% to the unemployment rate. So the unemployment rate would be expected to go to about 8.5% from about 7.5% under a free trade agreement. And finally, the long-term impact on public debt. There, it's expected that if we move to WTO, the public sector net debt impact would rise to about 106, 107%. There'd be a net increase of about 3% of GDP. That's not massive, it's about £50 billion, but nevertheless, obviously in the current climate, any addition to debt that we're seeing at the moment is not welcome. Where do these added constraints come from? Well, of course, they are pretty much the same as COVID to some extent, but I think far more enduring. The response of businesses in terms of investment, the rise in structural employment, if we're not seeing the same degree of trade, the rebalancing of businesses to different areas because they can't compete effectively abroad. All of these factors are going to have a long-term enduring impact on the UK economy, which will leave the economy weaker and smaller than it otherwise would have been. If you look at the next chart, please. What does this mean for bank rate and inflation? Well, the central expectation is inflation will move higher next year. At the moment, inflation is running at about 0.7% year on year. That has fallen rapidly this year, but it's mainly been due to one-off effects. The cut in VAT, the Eat Out to Help Out scheme, obviously reduced the cost of restaurant meals in August. And also the drop in fuel costs that we've seen this year, all have weighed heavily on the headline rate of inflation. Those will drop out arithmetically over the course of 2021, assuming they're not repeated. The broader question is, to what extent does the damage to the supply base of the UK economy drive inflation higher? If the economy is recovering, but we don't have the ability to meet that supply because of various sort of fundamental supply constraints, then of course the tendency is for businesses to raise prices. Now, the Bank of England has some of that forecast embodied in their projection here. They've got inflation moving back to 2%, ironically, well, coincidentally, just around target. Potentially that move over the medium term could be far sharper than that, particularly if the pound weakens on the back of a bad Brexit scenario, when we get a fundamental weakening of the pound, which drives import prices higher. The Bank of England is not expected to do anything in the current environment. It announced another 150 billion of quantitative easing at its last meeting in November. It stands ready to cut rates again to negative territory. They have said that. I think that I'll be staggered if they cut rates to negative territory in the current environment, though. I think it'll be absolute last resort, particularly given the sensitivity of the currency to interest rate movements. I don't think they'll want to exacerbate any nervousness in the currency markets at the moment by cutting interest rates and making their return on UK assets less attractive than it absolutely needs to be. Which takes me to my final slide, which is the currency outlook. The pound has been beset by conflicting forces over the course of the last couple of years, and obviously over the course of this year. Generally speaking, the pound has come under some downward pressure against the euro, but it's actually managed to stay something of a rally over recent months against the dollar. Sterling dollar, the chart on the left-hand side, is currently around 133-ish. It's come under some pressure this morning, not surprisingly. The range of forecasts for sterling dollar is wide. Again, that speaks to the uncertainty that we have on the UK at the moment. But if you look at the range of forecasts amongst economists out there, the back end in the 12-month forecast ranges from 120 for sterling dollar up to 148. The central forecast is about 138. So the central forecast, as you can see from that mildly tilting upward line, is for the pound to make some steady progress over the next 12 months. Against the euro, the range, again, is very wide, 104 in 12 months' time, up to 119. Again, the central expectation is for steady, gradual increase over the next 12 months. Well, what is the likelihood of that? Well, I think there's a number of factors that are going to be at play here. One key factor is the potential weakness of the dollar that we're seeing at the moment. We're seeing a massive flight of money out of US dollar assets into higher risk markets on the back of optimism over the COVID vaccine. So the dollar has come and could continue over the short term to continue to come under downward pressure, particularly if they announce another fiscal stimulus. There's rumours of another speculation that they'll roll over a $2 trillion fiscal stimulus, which if they do that, would also potentially add to the dollar's downside. But against that, of course, we've got structural constraints on the UK economy. We've got the Brexit risk to worry about, and the potential inflation risk that could come from all of that. So I'm mindful of the ability for sterling to rally at the moment. I think it is undervalued on sort of many metrics, but I am mindful in the first quarter we could see the pound coming under renewed pressure. Particularly against the euro, I have to say. I think there's a risk we could see sterling euro testing parity in the first quarter if conditions do deteriorate. But over the medium term, I would anticipate that there could be some pressure against the dollar. but probably not that much change. But I think you do see the range of uncertainty out there at the moment. I think to nail down any meaningful forecasts, we need to get a clear idea of the line of sight of what the Brexit negotiations are going to show. But so the key message, I think, therefore, is that, I mean, clearly conditions next year will be better. The optimism is the vaccine, I think, is a game changer. But we do seem to have swapped one massive uncertainty for another, as is the want of the UK at the moment, to shoot ourselves in the foot. That said, we've got 2 weeks before the end of the transition period. If Boris Johnson can pull something out of the hat, then all well and good. The conditions for 2021 would be that much better. But at the moment, uncertainty is going to remain the big name of the game. Thank you very much for listening to me. Next slide is I think I have my disclaimer on there. I'm not responsible for anything I've said. But with that, I'd like to pass over to James, who'll talk to you a little bit about FX implications at the moment. Thank you.
Thank you very much, Adam. Good afternoon all, and thanks firstly to Carl, Joe and Oldfield for hosting, and Adam for the invaluable insight into the economic outlook for the UK economy. My name's James. I work with Cambridge Global Payments, providing tailored solutions and strategic ones to currency risk management. So if we head on to the first slide, I appreciate it's going to feel like speed dating today. So I'll leave all these points on here for when the slide deck is shared about. But I've highlighted the key issues, the key points. Our parent company is FleetCor, who acquired Cambridge back in 2017 and has a $22 billion market cap that enhances our own credit credentials exponentially. So we are therefore comparable to a bank with the benefits of being a broker whose key focus is in SME, mid-cap, owner-owned businesses. Unfortunately, we saw a few currency providers disappear throughout the course of 2020 as COVID-19 takes its toll on the financial services sector. And I've posed the question there, as businesses, have you considered the credit quality of your current provider? Because you want to be confident when entering into financial transactions that your counterparty will be there to deliver on all future data contracts. On the next slide, I just want to briefly look, I know Adam's taken a focus on what's to come. I'd just like to look at two data periods in the past in the currency markets. The first being between March 2016 to 17, and the period obviously of the EU referendum. This was clearly a testing time for many of our clients. The market experienced this level of volatility when we didn't even know the facts of the new world, the post-Brexit vote. In reality, it could be even more volatile going into 2021 and beyond. If you consider the next slide, shows a similar relationship was felt in people trading euros. And our efforts in this period and the years following are geared towards providing peace of mind to our clients, as so many things remain uncontrollable. Management teams work with us to develop solutions to strategically navigate a changing landscape for the pound, as you can see graphed there. The next slide is the COVID influence period, so March this year. It goes to show just how external shocks to economies can't be factored in by any forecasts. Economic forecasts were available and clients did have their opinion on the currency direction. However, nobody could predict this level of volatility. So you can apply a prudent risk management approach that reduces the severity of these shocks, which is what we did. So on the next slide as well, you can see the trend for sterling euro. Our clients at the beginning of the year were blind to just how much COVID was going to impact their purchasing power abroad, but having an active risk management approach with us to their currency needs effectively mitigated this initial shock in FX and allowed them to focus on other parts of the business that could not have this protection. I wanted to highlight on the next slide that our target clients are clearly you all, SMEs and mid-caps, because why else would I be here taking up your time? And it's aimed to really understand, and it's our aim to really understand how international trade plays a role within your company. Our approach isn't driven by hedging products, but rather to get an acute understanding of the challenges currency creates and understanding of your opinion in the market, and then work with you to complement your approach to risk whilst identifying further and future risks in an uncertain world. The key to any relationship or risk management approach is a consultative one based on trust. On the final slide, I'd like to thank everyone for listening. I know if you'd welcome a conversation today, And myself and a few of the colleagues I work with closely this afternoon are available to speak, and we shall aim to reach out to you all in the future. Thanks for your time.
Thank you, James. And thank you, Adam. That was very insightful, I thought, and helpful to all of us on this webinar this afternoon. Just to get some insight into the economic and financial arena is actually very valuable. Whilst none of us can exactly say precisely what's going to happen in 2021, I think we're very optimistic, and I honestly believe that 2021 will be full of opportunity, but some knowledge of the risks and opportunities that exist really helps us plan ahead. And that's, I think, what we've been listening to, the risks, but also the opportunities of planning ahead in 2021. So now we're going to explore some of the tax opportunities over the next 6 to 12 months. These are, I think, well worth a look at. And the first one is annual investment allowance. So it's just been notified that the annual investment allowance of £1 million per annum has been extended for the whole of 2021. What is annual investment allowance? Well, it's a very useful provision whereby a business can invest in qualifying capital expenditure, and they can obtain 100% write-off in the first year against taxable profits. So that means, for example, if you're a company and you invest £100,000 in qualifying capital equipment, you can reduce your tax bill by £19,000. And of course, for a sole trader or partnership, the savings are even more. So qualifying expenditure includes plant and equipment. For example, forklift trucks, racking, computers, commercial vehicles, just to name a few. Unfortunately, it doesn't include, at this point in time, doesn't include cars or commercial property. Also, you need to consider how you're going to actually pay for those items. So you need to be really careful to either pay for them outright on invoice or fund them by means of hire purchase, asset finance, or some other form of loan. It's worth just pointing out that leasing doesn't qualify for annual investment allowance. It's a very complex area. So obviously, contact us if you've got a large purchase coming up and you want to find out the best way of doing that, be free to contact us. Basically, now is a really good time to invest in plant machinery qualifying expenditure from a tax perspective. And also, interestingly, many businesses have spare cash available right now. They may have taken out a bounce back loan or a CBILS loan, and they have spare cash as a result. So consider investing some of those funds, if you're in that position, into capital equipment and therefore reducing your tax liability. The second opportunity we have is dividend tax. And dividend tax rates are relatively low right now. You can see the lower rate is only 7.5% at this point in time. And we've already heard about the pressures that are on the Treasury in terms of their funds being squeezed, fiscal pressures and so on. And whilst we don't know what will happen to these tax rates from next year onwards, what we're recommending is that you make sure you use them this year. So you may want to consider declaring a one-off dividend before the end of the tax year. Even if you don't actually physically draw that cash, you may want to vote the dividend and draw the cash in future years. And your tax accountant should really be discussing this kind of thing with you as we approach the end of the tax year, if not before. The third opportunity is around capital gains tax, and rumours really abound regarding increases in capital gains tax. It may well be that capital gains tax rates will increase in the budget. Most likely that will be from next tax year, although there is a possibility that it could be from the day of the budget. So what we're recommending is if you're making any capital gains, do your best to try and make them fall into this tax year, preferably before the budget date, which I believe will be sometime in March. Examples of a capital gain are sale of a commercial property or sale of a business or part of a business. That's quite pertinent because we're finding with our clients that a lot of our clients are buying parts of businesses or selling parts of businesses. That's a very common thing at the moment. So that's a good example of where you could make a capital gain and therefore make the most of low tax rates right now. Interestingly, it's not just those items we mentioned, but if you get the right advice, it can include sale of intellectual property, goodwill or shares in your company to maximize those low tax rates. And that's particularly pertinent if you're thinking of succession planning. So if you've got a company and you're thinking of reducing your share in that company, maybe passing it on to future generation. In a family business example, we often see that persons kind of want to reduce their shareholding and they consider either gifting shares to younger family members or actually selling those shares. Well, neither of those options are actually the most tax efficient option. The most tax efficient options available are around selling the shares back to the company. And obviously we'd be very interested in talking to you if you're thinking about succession planning and giving you those opportunities. I think the key point here is those capital gains tax rates are very, very low at the moment compared to the top rates of income tax. So why should we not want to maximize those while we have opportunity? So thank you for listening, and I'll now hand over to Carl Taylor, who's going to share some gems on profitability and cash flow. Over to you, Carl.
Thanks, Joe. That's great. That's very interesting to hear about those opportunities from a tax perspective. So I'm going to just cover off on 3 key tips to maximize profitability and cash flow as we move into 2021. As we said before, times are uncertain. We don't actually know what's going to happen in 2021 really, but we don't think that any small or medium-sized business should be heading into 2021 without actioning these 3 key points. So I'm going to run through these 3 key points quite quickly in turn. So the first one there is just making sure you've got a financial plan and a 3-way forecast. We've said it before, but we're going to say it again, that we really feel it's critical that every small, medium-sized business has got a financial plan clearly set out as they move into 2021. So you know exactly where you're heading. You've got that clear plan that you can measure performance by. And it's really important that it's a 3-way one as well. And what do we mean by that? We mean a forecasted P&L, profit and loss, because that tells you, what's your profitability going to look like. It gives you clear budgets to measure performance by. Forecasted cash flow tells you what your trends are going to look like from a cash flow perspective. You know whether you're going to run out of cash, whether you need more finance, and it really helps you to plan ahead to stay liquid. And then forecasted balance sheet, it tells you what your equity is going to look like, and it makes sure that nothing is missing from your forecast. So there's still time between now and the end of 2020 to make sure you've really got that nailed. I think it's really important. Especially if we're looking at a significant bounce back in 2021, sales increasing, cash flow may come under more strain. The second key point was just keep a tight focus on debtor control. Again, we've said this one before, but we think it's really worth saying again. We must keep a tight focus on credit control as we move forward through this final bit of 2020 and into 2021. If you haven't got enough resource on credit control right now to make it happen, it's really urgent that you get that resource on board in your team so that you can tighten up on credit control. And what we've seen over the past week or so with some of these big retailers going bust, it really shows us how lockdowns and COVID has impacted some industries severely, and you just need to think about the knock-on impact of that on your customers and on your debtors. Some of your customers could be impacted by it. some of them could be impacted by similar situations. And it's really key that you minimize the risk of any bad debts by keeping really tight focus on credit control. It's just a really important point. We wouldn't want anyone on this webinar to be hit around the back of the head with an unexpected bad debt that would kind of impact you as you move into 2021. And the third and final point was, by all means, let's be optimistic and positive about what 2021 holds. Let's focus on the opportunities there are and do everything we can to maximize those. But because things are uncertain, we should stay conservative on our budgeted costs. We've seen many businesses become much more efficient during 2020, cutting costs, maximizing the use of technology to interact with customers using Zoom, etc. Let's not throw those efficiencies away as we move into 2020. Let's keep the efficiencies that we've gained in 2020 right through next year, but let's focus on the opportunities as well. So that's just 3 simple points, but I think they're really important fundamentals that we must make sure you've nailed as you head into 2021. So we're now going to move on to the questions, and we've had some questions come in, and by all means, if anyone's got any more questions, feel free to put them in now as we go through. So I'm going to pull these questions out, and we'll try and get some answers to these. So the first question I've got here is for you, Adam, I think. Which sectors of the economy do we expect to do well, and which sectors do we expect to do not so well as we head into 2021? Don't know what thoughts are.
I guess there's 2 sides to that story, because there's some sectors clearly are going to do much better with the effective rollout of the vaccine. Of course, those are the sectors or industries which have been hit very hard this year, most obviously hospitality and leisure, accommodation, retail to a certain extent, tourism related industries, and anything involved in those supply chains. So clearly those areas, I think, potentially will get something of a windfall as economic conditions hopefully normalise. Balanced against that, of course, you've got the potential dislocation caused by Brexit. So those industries, those sectors which have disproportionately high international exposure, both in terms of import penetration but also exports, are potentially going to get hit. And obviously manufacturing within that is a broad sector which is internationally exposed. Within manufacturing, chemicals, the auto sector, of course, is in the news at the moment. Obviously tariffs imposed on car parts could hit the auto sector quite hard. So it is, I think, going to be somewhat nuanced in terms of the implications. But overall, I think, yes, all sectors should do better, I think, from the improvement in demand, but some sectors not quite as well as others.
That's good. Thanks for that, Adam. I think just a sort of little tag on to that is there anything specific in terms of the outlook for construction and civil engineering? Question here.
Yeah, look at the housing market at the moment. Actually, the housing market is having a remarkably strong time. It's difficult to disentangle how much of the improvements in the housing market we're seeing at the moment is just latent demand from the lockdown in Q2, but housing transactions in the 3rd quarter went through the roof. I think the highest was something like 10 years. So clearly there's pent up housing demand. Construction clearly isn't particularly internationally exposed in terms of demand, but of course it has key supply chains that are reliant on imports, the imports of the raw materials, bricks, etc. So clearly the construction sector potentially could get hit quite hard by any adverse moves in terms of import tariffs or delays in getting the necessary raw material for building. On a broader point, of course, though, the demand outlook for construction, I think, remains positive. We still have a housing shortage in the United Kingdom. The government is committed to levelling up, and I think that speaks to the investment agenda north of the border. There's a lot of public sector involved, big public sector infrastructure projects that are going ahead. So I don't think any of that is going to get derailed by the rise in borrowing or the rise in debt that I've outlined. I think to the extent that's investment, or the government see that as investment, I think it will continue. But the other key issue as well, of course, which speaks to the Brexit debate as well, is skill shortages. getting the necessary talent to actually come in with the right experience, having enough people on the ground to be able to build. And of course, if the public sector is competing with the private sector, then I think that could be a key issue for private construction companies, just making sure they've got the right people, and indeed they're paying them enough, because of course pay pressures could start to be brought to bear if we haven't got the same influx of foreign workers as we have had before.
It's very good. Very thorough overview there, which is brilliant. We've got another one here for you, Joe, I think, just based on the points you were talking about on annual investment allowance. So the question is, the annual investment allowance, does it apply only to new purchases for capital equipment, or does second-hand equipment come in under annual investment allowance as well? And just the question about electric cars as well.
Yeah, I'll take those two questions
Yeah.
together. Annual investment allowance is for any qualifying purchases, so new or second hand. Yeah, the example given is a second hand truck allowable. Yes, it is. On cars, electric vehicles do have it's not annual investment allowance, but it's a first year allowance, which is 100% write-off as well in year one. So no, electric cars can't be claimed under annual investment allowance, but they can be claimed under first year allowance. So just a slight distinction there. Hope that helps clarify those 2 points.
You'll still get your 100% tax deduction for for those electric cars. So it's a subtle difference, but it does make quite a difference if you're investing in a lot of capital equipment. We have had clients where they've used up the whole 1 million annual investment allowance, but then they've actually bought a couple of electric cars on top of that, and you can get your 100% tax deduction.
And annual investment allowance, new or second hand, first year allowance on electric cars has to be brand new. So they love making it complicated for us, basically.
Yeah. So another question here. I think this perhaps is for you, James. If you purchase currency forwards with a 0% deposit,
yep.
What is your exposure, if any, should the broker be unable to fulfill? That's perhaps off the back of your comment at the start.
Yeah, I think obviously in an ideal environment, every forward that you place with any FX broker, it should be given that they can fulfill the entire length of the contract. The concern that we've seen, certainly with our clients that have come to us over the COVID period, is that big market movements and big volatility in currency markets can put brokers under a lot of strain if they don't have the back end credit facilities and the liquidity to support their positions. So the reason I mentioned it is that it's always worth considering partnering up with a provider that has a strong backing, both from a balance sheet perspective, but also from purely the amount of banks that they've already engaged with and the product suite that they've got to provide. So if you've got a 0% deposit forward contract out with one provider and they're effectively smaller than your business, then that might show you an alarm that whilst you're taking liquidity from a business, there might be a real risk there if there was another external shock, or if they're still struggling with COVID, to be able to fulfill that in 2 years down the line. Whereas if you consider partnering with a business without being too salesy, that has the balance sheet to support the range of hedging products that they're placing in the market, then you can have confidence that in 2-3 years time down the line, when those currency contracts come to mature, that the same provider will still be there to support your business in that period.
Thanks, James. I just got a couple more questions before we close off. We're nearly done. There's this question about how we manage VAT reversal scheme and our cash flow, which is it's a really good question. There's not really any alternative, basically, other than to plug it into your cash flow forecasts and look at the impact on your cash flow forecast. There's not really any other alternative to assess how it's going to impact you. There's there was just a comment about, are we correct in thinking that 100% allowance also applies to hybrids with CO2 emissions under 50 grams per kilometre, which, Joe, I think basically the answer is yes until March 2021.
Correct.
And the final one, I think it's probably for you, Joe, but it was just, is the message to maintain high levels of liquidity in the business into 2020 as we go into 2021, or is it a good time to take advantage of tax-free pension scheme, tax reliefs, or to reduce tax on drawn earnings? Which is an interesting question, which I'm sure you'd like to answer, Joe.
Yeah, I think my answer would be both, really. Yes, it is the right time to maintain liquidity in the business. Now is the right time, and always is the right time to maintain good liquidity in your business. And as a guide, what we say to our clients is keep 3 months worth of overheads in cash in your business bank account if you possibly can. You know, that's the right level of cash to maintain. But the other half of the question was, is it a good time to invest in pension contributions whilst the regime is so favourable? And the answer to that is yes as well. But I think you need to be really careful to have a robust cash flow forecast like Carl's been talking about, to plan out obviously how much cash you're likely to consume or indeed need through the year. And really that's the answer to the question, isn't it, Carl? Back to you, really. If you've got a robust forecast, you can make informed decisions on things like pension contributions. But yes, it is a very good time. The regime is absolutely brilliant on pensions at the moment. Good time to think about that as well.
Good. Thanks, Joe. We're really going to close off now. It's been great. We'd like to thank everyone again for coming on board this afternoon. It's been really great to have everyone with us, and it's been great to host you. And if anyone wants to discuss any of the points we talked about with us, then feel free to book in a conversation with us. You'll find a link on the follow-up email coming after the event to do that. So, you know, if you've got any questions on tax points we've talked about, or on the 3 key points to maximize profitability and cash flow, then we're more than happy to talk on that. There's still time between now and the end of 2020 to get things in place, to get the right kind of forecast in place for 2021. If anyone wants to speak to Adam or James, feel free to make contact with them. Contact details are on the slides that are coming through, and they have been on the screen as well. So we'd like to thank you very much again for joining us this afternoon. It's been great to have you all on board, and we'll keep in touch and look forward to hearing from you again. Thank you very much.
Thanks ever so much.
Thank you.
Thank you.
Cheers, Carl.
Thank you.